Hello everyone, welcome to the channel. If you are preparing for chartered accountancy or if you want a strong conceptual clarity in accounting standards, the channel is the specifically for you. Here we don't just study standards, we also cover GST, direct tax, indirect tax, and also company law. We understand the logic behind them and the exam approach and the real world application. Today we are starting the one of the most important and fundamental standards in the AS2, that is inventories. Before we begin the technical concepts, let's first understand why Ind AS itself important. Ind AS is not just another set of accounting rules, it is an Indian's version of globally accepted accounting standards aligned with IFRS. This means whatever you learn here is not only useful for your exams but also directly applicable in real world financial reporting, audits, and corporate practice. So now coming to the India S2, the standards plays a very critical role because inventory directly impacts profits. Even small mistakes in valuation can significantly overwrite or underwrite your profits. So in this session, you will not just learn the theory, you will understand how inventory is valued, where mistakes usually happens, and how questions are asked in the exams. Let's start most basic and important question. What exactly is inventory? Inventory is an asset. Inventory is an asset. Of course, it is an asset only, but it is a current asset because it can use for more than 1 year. As per asset definition, if any asset has been used for more than one useful life, that would be the asset for us. So inventory is also an asset. But how all assets are inventories? No, we have to specifically separate inventories as an covered in this standard. So here we see inventories are assets which are held for sale in the ordinary course of business, that is finished goods. I mean held for sale. Example, if you have an hotel business, there are a lot of groceries required to maintain your stock, like oil or food items, everything. All these are inventories. And also, you don't need to process them as a finished goods, right? So, a little bit process is required here. So, all these are the retail type of inventories. So, these are the finished goods as well. If you understand, now I hope you understand the concept of finished goods. So you have to finish the goods. I mean, say there is a factory, you took raw material, say thousands of raw materials you took, and raw material 1 to 10 types of raw materials you have taken, and you processed here. Here you processed the activity what you have to convert, and then you convert it into finished goods. These are called finished goods, and these you ordinarily sell to the your customers. Say example, you have a mobile factory, so you took thousands of raw materials from your vendors and created a one mobile with using the labor material, office buildings and depreciation, I mean plant and machinery and other activities. You created one mobile, and then you packed that mobile into one good packing material, I mean one set of box and that charger and everything. See, this bit became a finished goods for you. So your mobile selling business, this is your core business. That way you are using ordinary course of business, then it would be your finished goods. Then you come to the next point. In the process of production, that is at the year end, at the reporting date, say example 31st March 2026, at this reporting date you have finished 30% of your production, and balance has to be performed in the next financial year. So at this date you have to report as work in progress as well. Say thousands of materials you have taken, and processed, but 100% process is not complete. So entire mobile is not complete. So only you designed one platform and panel for them. You still have to give the software, and you still have to give the screenshot and sim insert ports, and everything has to be do. So only 30% is happened by this date. So balance has to be do on your own, I mean in the next financial year. So this would be the working progress for you guys. On a particular date you have to see the what is the working progress, the valuation and all. I will tell you in the later of this chapter. And then materials at the same time on the same reporting date, on the same reporting date, you may not complete entire process because you have taken thousands of raw materials, but you didn't use entire those raw materials by that date. You might have by this 31st March 2026, you might have used only 80% of those material. So balance 20% would be the your finished, I mean raw materials applied for the consumption in a future business. So ultimately, only these few things are, some spare parts are there that I will cover in the end of this chapter. Most of the spare parts, whether you are you using for the production process or are you using for the, I mean, plant and machine. I mean PPE. In PPE, you will cover spare parts part also. But here, you time being you ignore that point. I will cover in the later videos. Then see, your important is inventory is anything that will ultimately generate revenue for your sale or service. So I explained only manufacturing point of view. But if you have a service oriented, that is also in service industry also you might have some inventories that you have to cover here. So see, let's jump into the standard. Now, what is the objective of the standard? See, if you see inventories, valuation of inventories. Ind AS 2 to prescribe accounting treatment of inventories. What is the accounting treatment? Accounting treatment means how we have to account. I mean, it is an asset, current asset, and also we need to show how we need to show and how we need to disclose and how we need to account. Means valuation. If it is cost or NRV, whichever is higher. If it is NRV is less, so your cost will be the same. If in NRV is more, no, if your NRV is reduced less than your cost, so the balance how to you return off, like you need to show in P&L expenditure or directly in P&L, it will automatically adjust in the gross profit. This you need to see. I will tell you in the next 5 to 10 minutes, but you just observe these frequencies how it will come and all. See now, accounting treatment of inventory is how you have to account, including cost, NRV, and recognition of expenditure. That's what I'm saying. I will explain for cost first and NRV next, and this I will explain after these concepts. So before knowing this concept, you don't need to, you can't understand other concepts. So now you cover the definition, right? What are inventories? That you can note this down, which are assets which are held for sale in the ordinary course of business, or it is in the process of production, it may be work in progress, or materials or supplies consumed in the production of process, in the production of process or services. Those are the raw materials. See now we see the water cost breakup. First, how we have to value. Say suppose on 31st March 2026, you have 1000 rice packets, 10,000 rice packets. How we have to value these rice packets on this date? Say you have you bought these rice packets at each rice packets value of 5,000. So what is the your value of inventory? Straight away you can't tell 10,000 in multiplied by 5,000. That would be the wrong if you observe standard. See, there is a measurement principle. This just I am just explaining why I am explaining the cost to you. There is a measurement principle here. What is the value of inventory? For that you need to learn how to value inventory. Here lower of cost or net realizable value, whichever is lower is the your price. Say suppose what is the NRV for this rice packets is the question. Before we find this NRV, first we need to calculate how. First we need to understand how they get this 5,000. If you understand this 5,000, you might have completed part of the definition. So now come to the cost components. I hope you understanding the concept. Let me know if you have any questions in the comment section. See, what is the cost? Cost of an inventory. First, you have to calculate cost of the inventory to measure the inventory in profit and loss account. Now you see cost of purchase, cost of conversion, and other direct cost, and which is required to being bring in a present condition. Okay, this you note this point. Then I will explain one by one. The cost of purchase. Say suppose you are the one factory. In factory, you are manufacturing watches. For watch, I mean not only general watches. Say suppose uh, there are some big brand watches also that would be very costly. So those kind of watches you are manufacturing. See here you might have required few production process to complete this watch mechanism. See, if you understand, I will explain. If you want to create a watch, bear my drawing. If you want to create a watch here, you need to create one die and the chain and the model and everything. First you need to design how you have to compete in the market. This is the one cost. And second cost is you need to buy raw material for it, and you need to set one plant and machinery if required, or and you need to create hire some labor means they might have fixed these items. All production is cannot happen in the plant and machinery, right? There might some labor required. So those kind of labors, and also all this setup has to do in one building, right? You can't do it on the roads. So for that building cost and the depreciation, all these are used to create that watch. This is how it happens. So here you need to see how we incurred that cost and what are the cost included there. So these are the small example I can. So let's see. So to create that watch, you first buy raw material, and then say suppose if you import those raw materials, say example 10,000 raw materials. I mean the dice. You can say die of the watch. 10,000 dice you bought. For the 10,000, each carries each cost 2,000 for us. So 20,000 is your, say suppose 20. So 2 lakhs is your cost. And then they added some duties. What kind of duties? Refundable duty, non-refundable duty. Refundable duty is 10,000. Non-refundable duty is 5,000. What is this refundable duty? What is this non-refundable duty? Refundable duty means you can adjust that refundable duty from your payables in future. That is called refundable duty. If you want separate video on this refundability, I will do for CPT students, for IPCC and students also. But if you are a finals guy or professional, already professional guy, you don't need to explain on this guy. So to explain this kind of concept, I will make separate videos based on the comment section, or I will explain separately. See, simply I will refund. See, suppose after creating this watch, you might sell that in the market for 5,000 rupees. So in this 5,000, it would be inclusive of GST, or you can charge more GST or VAT on this indirect tax on this. So say suppose in this 5,500 is your tax that you have to pay to the government on selling of this watch. But whenever you pay the refundable duty in your purchases, you can adjust the 10,000 in this sale of one watch. Say suppose you are selling 1,000 watches. 1,000 into 500, say suppose that 5 lakhs. In that 5 lakhs, you can adjust this 10,000. Then 4,90,000 you have to pay to the government. So this is the refundable duty. Not only this kind of rebate, Not only this, you also get refund from your government. Say therefore you are exporting watches, so now you don't need to pay tax on it, so you can claim input as a refund. There's a separate concept. Now I hope you understand the refundable duty and non-refundable duty. Why I'm telling is, if it is a refundable duty, you don't need to add in the cost of inventory. Say suppose total cost here is 2,15,000, out of which non-refundable duty you have to add to the cost. So you need to remove this refundable duty, and then the cost of your raw material is 2,05,000 only for time being. So this is how you have to include or exclude of refundable duties. And then transport cost and packing material, all these cost has to be included in the cost of inventory. And then you have to remove discount. What kind of discount you have to remove, I will tell you. Say suppose in the previous example you have taken 20,000, 2 lakhs is the you have 2 lakhs bill. After that duty, before duties I'm telling, but in one situation you went to the customer, I am buying more inventories from you, so I would like to get a discount. So buyer itself and our buyer and seller both decided your 10% is your trade discount. I mean trade discount. They negotiated and discussed, and then 10,000 they reduced from your cost. Then 1,90,000 is your cost, and then they added 10,000 refundable duty and 5,000 non-refundable duty. Okay, if you add this refundable duty and non-refundable duty, your cost will come after adding this. Total cost will come. This will you pay to the invoice, but while evaluating inventory, this refundable duty you can create as an asset. So I will create a small entry here for your understanding. Say suppose entire cost. What is the total here? 2,05,000, right? So because earlier they had 2,15,000, so 10,000 has given discount. That is, yeah, the 2,05,000 is the cost. Say now how you will account this? First of all, you get this bill. There is a condition in the agreement. If we pay this 2,05,000 within 30 days, you will give discount of 5,000 also. This is cash discount. See, on the day one, on purchasing of this while paying, I will account like this. First of all, what is my raw material? Raw material debit account. This is our cost, and this is non-refundable duty. This we need to add to our inventory, right? This is the total cost. 1,95,000 is debit, plus to creditor you need to pay this side. So this refundable duty is there, but this is input credit debit. Input credit either GST, GST, IGST or VAT if you are old guy. Let's see. This is how it is. This is refundable duty 10,000. To whom we need to pay this? To, say suppose vendor, our vendor who are supplying these products is customer X account, credit 2 lakhs 5,000. This is how you account. That is why this you cannot add in the cost of inventory. So your raw material cost is 1,90,000, you need to pay 2 lakhs 5,000 to him, and there is a 30 days clause here. I mean, if you pay within 30 days, you can able to get the discount of this 5,000 also, as per his understand, as per his agreement. See, if you pay this 5,000, do okay, this creditor will reduce. If you won't pay within 30 days, this will same. So this may impact this inventory. This is irrelevant to this is irrelevant to for your production process. This is directly depending on the payment process. But in definition, what we learn, which is ultimately generate revenue through sale or service, which in the ordinary course of business. So payment is not your ordinary course of business. It is a substantial business process. But your production process is not effective because of the payment terms, right? So that is how you understand. And then that is why we didn't include this trade discounts. Okay, sorry, we didn't include this cash discount. If it is a cash discount, we don't uh, take effect of this cash discount in this 1,95,000. Say suppose I will tell two options in this payment class. Okay, sorry, option 1 and option 2. In option 1, you have paid within 30 days. You have paid. In option 2, within 30 days you didn't pay. In this case, you only pay 2 lakhs to the creditor. In this case, you paid 1,95,000 to 2,05,000 to the creditor. So these 5,000 discount is there, na? Out of 5,000, it would be trade discount to you. This would be indirect expenditure to you. Trade discount expenses to, sorry, trade discount is not your expense. Trade discount is other income, right? So you need to trade sundry creditors. Say suppose it's account debit 5,000 to other income through trade discounts 5,000. This is how it will close. If you won't, here in this case, if you won't pay this, I mean, if you won't pay within 30 days, you can directly creditor account X account debtor to bank account 2,05,000. Here creditor X account 5,000 discount, and again another entry creditor account 1,95,000 2 lakhs to bank account. This is how the treatment of accounting of these discounts. So you should understand these discounts concepts clearly. I will give the examples also while solving the inventory problems. I will give examples for this also, but I am just telling for your understanding purpose. So now you understand price, duties, discounts. And the transport is also important, and transport and packing material both. There will be packing material also, primary packing, secondary packing, everything. This is also transport and these packing materials similar concept. So I will explain both at once. Okay, the, say suppose if you say watch manufacturing or mobile manufacturing, if you see the process of the production, see the understanding. You have a factory here and you have a retail house here. This is the factory and this is retail house. So here the production process will happen. Here entire production will happen, and you buy raw materials from me there from these, and you process that. Here you process the raw materials and you you created finished goods here. I mean mobile or watch, whatever it is, you created it. I mean you finished the production, but you have to pack that material. So you cannot sell the mobiles or watches like that. You have to pack one material. In that you should set your logo, and you put mobile in that box and the charger and the open pin. Earlier we used to get earphones also, and you cover this package with one another cover. On that cover you need to write their brand and the model and the features and the rate, important rate, and others. So this packing material is required to sell to the customers. So all these packing materials are included package. All these packages included in the inventory, but there would be a secondary package. These might be thousands. These might mobiles maybe at that you can't create in factory you can't create one mobile, right? So some bulk of mobiles will come, say so thousands, lakhs also is there. So these has to pack in separate boxes like this, that you need to send to warehouse and all. This pack box, this is the secondary package. This customer won't get this pay to us. So these are our indirect cost, not a direct cost. So the packing material from year for main product is included, but secondary packing items we don't include in the cost of inventory. It is a selling expenses. Say suppose you created one label and try to sell the marketing as, and you give the promotions and all, is the secondary, is the marketing expense. It is not a primary packing material. The similar way, the transportation cost between raw materials to factory and factory to retail house, how where you are going to sell, all these are the packing materials ready available to ready to use, and in the factory stage, from vendors to your factory. See, I will draw that. So there is one factory here and there is a retail house here. So here mobile is ready for sale. So you packed everything and all, you pitched everything and all. Until this factory stage, it is included. Until this factory stage included. Post to this factory, you might send these to is a retail house 1, retail house 2. There are similar houses, or thousands of houses for you. I mean, in Hyderabad, in Vizag, in Chennai, in the Karnataka, there are similar few retail houses in your entity. So you could send them. So these are the indirect packing cost. I mean, indirect transport cost that may not include in the cost of inventory until ready for a sale in the at the factory stage. Is the cost you should include in the cost of inventory. In few cases in question they will ask like this: the transport cost till the customer is available for sale, even though it is a not only factory, even it is a factory retail house also. If they mention until the retail house, you have to put the transport cost as per customer contact, or as per the process of the production, or as per the conditions or situations, then that would be the that would be the cost included to you. Post that retail house to customer, if you send that uh, if you send that item from your retail house to the customer address, so this transport cost is not included. So that might be selling as an expense, is not an cost of inventory. So now you might have understand what is the cost included and what are the, how you understand the direct cost. So in direct cost there would be separate cost also there. Not only direct cost, to process that entire the process in factory, you might have included another direct cost. There's a cost of conversion. Once you put the raw materials, laying those in the factory for 10 to 20 days, that automatically it cannot become finished goods, right? So you need to process that in the similar, you need to process that cost. So that will not automatically come from year to year. So by saying 10 to 20 days in the factory is not happen. So you need to process. To process, you have to incur some costs like direct labor. See, in the factory there are some labor sitting in the factory and helped in the production process. Okay, so these are the direct labor. So say suppose for him you are paying 10, for him you are paying 15, for him you are paying 10. All this cost, this cost per hour. So how many hours he spent to create that mobile, those costs has been added in the cost of inventory. So these are the direct labor cost. And then overheads. Overheads means there are two kind of overheads: fixed overheads and variable overheads. Fixed overhead and variable overhead. Fixed overheads and variable overheads. If you see, your factory rent is fixed for you guys. So that rent is fixed overhead for you. Variable overhead means electricity. Electricity used for the factory is units how you used for the factory, that would be variable overhead. So this you calculate this variable cost, you can calculate by the number of units, but the fixed units are the fixed overheads are same for every month. And also some fixed costs are there. Say suppose to manufacture 10,000 goods, you need to incur, you manufacture to manufacture 10,000 goods, you need to incur 100, 1 lakh. 1 lakh is your cost. So if you manufacture 10,000, entire 1 lakh should be your fixed cost. Now you see the examples. Option 1, option 2, option 3. In option 1, you have manufactured 10,000 units. Option 2, you have manufactured 9,000 units. Option 3, you have manufactured 11,000 units. Now, you have to know how you allocate this fixed cost to the inventories. So, you have incurred entire 1 lakh. This is your fixed cost, right? So if you manufacture entirely 10,000 without any loss, so from this fixed cost 10,000 for how many units? For 10,000 goods. It is your normal capacity, you can say. Normal capacity means in your production process, if you spend 1 lakh, if you spend 1 lakh rupees in your production process, that will get 10,000 goods. This is called your normal capacity. So in this case, if you manufacture only 10,000, entire this 1 lakh is your cost of inventory. Say suppose if you created only 9,000, then what would be your fixed cost? What would your fixed cost in this case? So in this case, this 1 lakh divided by 10,000. So this 10 rupees per unit is your cost. So or your cost of inventory, you have manufactured 10,000 units and cost per unit is 10. So this 1 lakh will come automatically based on the calculation. This is the normal plain case. This is normal case. If you go to the second case, here the second case, you have taken only 9,000 units. Say suppose if I do the normal working, say suppose distance, I have incurred 1 lakh and normal production is 9,000. You need to allocate to the each unit to allocate the fixed costs. So here you need, if you see the 9,000, so your cost would be, 1 second, VCS will do on calculator only. Your cost would be 11.1. But see, you can't increase cost in fixed cost, right? You cannot increase, because if you say 10,000 is your production process, right? So 10,000 9,000 units into 9.9, that it is can't increase. So if you see the normal capacity 10,000 into 11.11 will equal to 11,000 will come in this process. So here you need to check how to calculate raw material cost for fixed overheads. You cannot add the 9,000 completely as per the standard. The standard will tell you, here one formula will give you the standard to calculate fixed overheads to the normal capacity and actual capacity is different. Then this normal capacity is 10,000 and the actual capacity is 9,000. So here what we need to do, there was some abnormal loss here, right? If it is an abnormal loss here, you cannot add that entire 100 lakhs to the cost of inventory. If you add this entire 9 lakhs, if you add this entire 1 lakh to the 9,000 units, your cost would be 11.11 will come. It means for incurring 10,000, you have included this much cost. There would be a abnormal loss. If you produced 10,000 to 10,000, there is no abnormal loss here. But if you produce only 9,000, no, there is abnormal loss. Abnormal loss means which is not expected in the normal regular production process. In that case, you need to eliminate this. How you need to eliminate, I will tell you. First of all, you calculate whichever is higher. I mean, actual capacity or normal capacity. What is actual capacity? Actually, we have produced 9,000 units. But what is our normal capacity is 10,000 units. So in this, whichever is higher you take, whichever is higher, I mean actual capacity or normal capacity, whichever is higher, which is 10,000. So 1 lakh by 10,000 is 10 units. So you have produced 9,000 units into 10. This is 90,000 your fixed allocation cost. So but you have incurred 1 lakh. You have incurred 1 lakh, but you produced only 90k in the production process. That balance 10k is called abnormal loss. This you can expense of in the P&L account. Can expense of this in the P&L account. You should not add this cost into the inventory because inventory is not considered abnormal losses. That is why they have given this formula. You remember this formula in exams. This is very important for CPT or IPCC final guys or in the normal in the fractional guys also. You should understand this. Generally, we do mistakes here. See what is actual capacity and what is normal capacity, whichever is higher. When you take the same formula, you can use here. So there's a difference between actual capacity, I mean normal capacity and actual capacity. What is our normal capacity? Is 10k. If we spend 100 lakh, I mean 1 lakh, we will get 10k, but we got 11k. Our production process has improved here. In this case, you cannot allocate that 10 lakhs and extra cost, because say 10th, say suppose 100 divided by 10 is 10 is our normal cost. So we have produced 10, 11,000. So it will become 1 lakh 10,000. This is wrong again. So if you production increase more than your normal capacity, same formula will come. Say suppose normal capacity or actual capacity, whichever is higher. Here actual capacity is 11k, normal capacity is 10k. So 1 lakh divided by 11k we have to do. Here 9.09 is the general cost. So 11,000 into 9.09, 1 lakh is your fixed cost allocation. So there is no transfer in this case. You can't transfer any fixed cost to the general P&L. The entire 1 lakh is your inventory. In problems you will understand this, but I will explain this. Yeah, here I gave one example also for your teaching purpose. There is a normal capacity of 10,000 units. Actual capacity is 8,000. Fixed overheads is 1 lakh. So rate per unit is 10,000. Inventory is this rate. Abnormal loss is 20,000 expenses. This I will explain this. See what is your normal capacity 10,000, but your actual capacity is 8,000 only. So what is your fixed orders? 100 lakhs. So here 1 lakh divided by 10k. Same. We took 9k example. Here it is 8k example. So our capacity is only 8,000. So 8,000 into 10. So your 80,000 is your inventory cost. So what about this balance 20,000? You have incurred 100, but you spent only, you get only 80,000 in the production process. So balance 20,000 abnormal loss, that would be expenditure in the P&L account. I hope you understand these normal production and fixed production details. So here you see the formula. Normal capacity in the practical, in examination also, this is most important. Fixed orders allocated based on the normal capacity. If it is in lower production, I mean If you are using as 10k as your normal capacity, if it is in lower production, abnormal cost would become, that would be expenditure in the P&L account. If it is higher production, reduce the cost per unit, because if you are expecting 10k, but the production given 12k units, so this 2000 you cannot transfer to P&L account, because these also inventory and this will sell to the customers, right? So that is why you limit that cost. I mean 1 lakh divided by 12k, what will it come, no? That will be the cost per unit. To calculate the per unit, this is the formulas. Okay, now you understand the cost breakup also, and components also have understand direct labor, overheads, fixed overheads, and variable overheads, and other costs. If any other cost required to present the obligation, I mean in the present condition to sell, that is also included. Say suppose some depreciation is incurred, and also some, to maintain this factory, there are some administration staff, and there are some account staff, there are some research and R&D staff, there are few staffs, and their testing and labs, there would be indirect material, all this. Out of this, they not only work for factory, they might have work for factory for few portions, just about 20%, R&D team only 10%, accounts team only 5% for this factory. So these portions has to allocate to the inventory. This is the cost of inventory while doing that. So anyways, now you understand the cost, what is the cost of inventory, and the now you read the definition of the measurement principle. If you read the definition of principle, what is your measurement principle? Means inventory is equal to lower of cost or NRV, whichever is lower. Mean you already learned the cost, now you need to see NRV. What is NRV? Now you understand NRV properly. Once you understand the NRV, you can complete inventory formula. Now I will take a break now, and I will explain NRV in the tomorrow's class.